With oil reaching $70 a barrel today, we need to ask if this rally is sustainable. Can crude keep climbing, taking the oil stocks with it? Take Whiting Petroleum, WLL, the big independent oil producer with hundreds of thousands of acres in North Dakota's Bakken Shale. Remember, the Bakken is not super cheap. That's the Permian Basin. But with oil just under $70, Whiting's practically printing money. The company reported just last week, and they shot the lights out. Whiting delivered a monster top and bottom line beat, and the stock caught fire. No wonder it's up 70% just for 2018, including another 1% today. So are the oils getting overextended here, or does the stock have more room to run? Let's take a close look with Brad Holly. He's the president and CEO of Whiting Petroleum. Learn more about how his company's doing, where it's headed. Mr. Holly, welcome to Mad Money. Good to see you, sir. Have a seat.
Hi, Jim. Good to see you.
Now, and in many ways, your oil company is a little different from everybody else because you have run this company conservatively. You've been trying to you don't like to overspend your cash. You've been lowering your the amount of debt you had, drilling efficiency better. So this is a good time for Whiting, given the oil's at 70, right?
Jim, it's a great time. And what we're trying to do is double-digit production growth by also generating free cash flow at the same time.
Now, when you use that free cash flow, it seems like that you're drilling a lot more, but you're also hedging. You've got, about 60 to 70% of your flow hedged. So therefore, you think that maybe oil's not going to go to 80, 90?
Jim, we think in the unconventional shale development that manufacturing and execution excellence is very important. So the hedging allows us to maintain our production and maintain our activity and generate those results.
Okay, talk to me about the drilling efficiency here, because it's a rather incredible trend for the last 5 years.
You know, it's been amazing, Jim. We're down almost to single digits now on drilling. We're under 10 days per well.
That's incredible.
We continue to just drive that
down. Double that 5 years ago?
Double that.
Yeah. That's just amazing. Now, you have a very novel compensation package. It's tied to the drilling rate of return. So how do you measure that, and how you do it?
Jim, we think that's good business. We need to be a sustainable business, and we need to generate long-term returns. And so that's a new metric for us this year. We're tracking it closely, but it helps us to make great decisions.
Now, you're also, you're upgrading, you're selling some, you're trying to monetize red tail. Just talk to us about how you constantly upgrade your portfolio.
Sure, we're always looking for tier one opportunities. Right. We're looking for that 10 to 15-year window of great opportunities to drill as a company, and we're looking for the highest rate of return possible in our portfolio. And so that allows us to be very active in portfolio management and look for those great opportunities.
Now, we know the Permian's cheaper than Bakken, but a lot of times it's how do you get it to the market, right? I mean, the Bakken's easier to get to the market than the Permian.
That's the great thing, Jim, about the Bakken. It's a very established basin now. 75% of the production goes out on pipe, but 25% still goes out on rail. And we've got both options. So there is excess capacity currently that we're enjoying out of the Bakken.
Now, you bought Kodiak, and you did pay a high price, but it looks like that it worked out in the end. How is that possible?
You know, it's really great. Most of the activity that we currently have today is on the Kodiak acreage.
It is.
We saw a great opportunity 3 years ago. Unfortunately, the timing of when we bought that was difficult with commodity price. Right. But now we're really reaping the benefits of having that Kodiak acreage.
So what is your primary goal here? Do you want to continue to reduce debt? I mean, if you keep going at these trends, you're going to have a lot of cash. What would be the plan?
It's both, really. We want to grow as a company, but we want to do that at a sustainable business. We're all about our profit margin, and so we want to increase activity when we can do that cost effectively.
Okay.
In the meantime, though, we've paid down debt 50% over the last 2 years.
That's amazing. I don't think people realize that. I mean, you were never in as much trouble as the stock indicated, right? I mean, from your point of view, but you had a big handle. You had a good handle on it.
We had $5.6 billion of debt at one time. We're down.
That's too much debt.
So we're down to 2.9, and we look to continue to pay that back to make the company strong.
Okay, so I know oil out 5 years, the curve is very different. It's in the 50s, but it looks like because of the problems that we're having in the Middle East, and we know we get a deadline tomorrow for the president's Iran policy. Do you think all of this political activity can spike oil even further than here, say year-end, go even higher?
Absolutely, Jim.
You do?
I think that's a great possibility. I think it's going to be very volatile going forward.
And a lot of, what can the president, I mean, it's theoretically Iran could embargo production? I mean, they could do an embargo again. I mean, what could Iran do that would make it so oil would spike?
You know, there's certainly geopolitical events that could happen, but we think the fundamentals are strong. We think inventories are in place. We think demand, 1.5 million barrels a day, is strong. We think that supply may have trouble making up for that demand, and so we're bullish on oil long term.
Wow. Geez, you really are. Well, you're certainly playing it the correct way, but you're being conservative. That was a lot of debt that you had at one time, and I saw your covenants and how things are going. You're still paying it down. You're in good shape. I want to thank you so much for coming on. That's Brad Holly, President and CEO of Whiting Petroleum. They have been WLL. They've been doing everything right. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.